Hello listeners and viewers, welcome to Kaduna State Ministry of Education Radio and TV e-learning program designed for our SS3 and other students staying at home due to the coronavirus pandemic. The present administration under the able leadership of His Excellency, Malam Nasir Ahmed El-Rufai, is positioned as always to ensure that under his leadership, our students are not left behind in all areas of human endeavors, especially education. Kaduna State is the center of learning. Therefore, we want to ensure that our students excel in their forthcoming examinations and beyond. Students and other learners at home are given this opportunity in order to continue learning, as education is a continuous process. Different subjects will be taught in this program to assist students to perform excellently in the forthcoming Senior School Certificate examination being conducted by NECO and WAEC as soon as schools reopen. Teachers making presentations will always provide their names and phone numbers during each presentation, and they can be contacted for questions, further explanations, and/or clarifications. The following numbers and contacts can also be reached for expression of any concern or observation: 090-865-00545 or 080-383-62072. Our website is www.education.kdsg.gov.ng. Our email education@kdsg.gov.ng or education.kdsg@gmail.com. Our YouTube channel, Ministry of Education, Kaduna State. Our Twitter handle @Kaduna_MOE. Or our Facebook page, Ministry of Education, Kaduna State. Stay safe, stay at home, and learn well. Thank you, happy listening, and happy viewing.
Hello students, my name is Mr. James Yaro. You are a regular accounting teacher. The topic of our discussion today is going to be on concepts and conventions of accounting. Concepts and conventions of accounting. Before I define this, I would like to tell you this. Before you come into the class, you must have to pass through the door. If you enter the class through the window, definitely you have flouted the rules guiding the entry of the class. So anything that one does, there are rules and regulations that guides him on doing it. So in accounting is not just practice anyhow or just like that. There are rules or regulations, procedures that guides accountants as they prepare accounting statements. So these rules and regulations or these procedures, we are going to look at them. Are concepts, are principles or rules which must be put into consideration when preparing financial statements. They are so basic that if there is any alteration of one of them, would change the entire nature of financial accounting. Well, conventions are procedures accepted to be observed when preparing financial statements. Although They are subject to change because what is material to one company may not be material to another company. For instance, some companies may provide depreciation for a stapler, while others may not. The concepts and conventions. The concepts and conventions are: 1. Business entity concept. Business entity concept. This concept states that in the preparation of accounting statements, the owners and the business must be treated as separate entities. That is, recognizing the business as a separate and distinct entity. Only those things that affect the business must be recorded. It is not concerned with other wells of the owner apart from those invested in the business. This concept certainly is saying you are the owner of the business, you are separate from the business. The business is not your personal estate or property. Once you have turned your business to be your personal property or estate, that business is bound to what? To crumble or close down. Majority of business people or majority of people have started businesses, but along the way, they what? They closes those business simply because of this, simply because of this concept. It says, be separate from the business. Some people have turned their business to be personal. If your brother comes to you or visits you, you give him or entertain him without paying. Funeral celebrations, you attended with business money. Naming ceremonies, you attended with business money. So as a result of this, and you are not paying these monies, since you are not paying this money, you have turned the business to be a private property, and that business is bound to what? To close down. And this business entity is saying that as an accountant, if you are preparing financial records, don't include the assets of the owners. He has cars, he has chairs in his room or in his house. His house should not be included among the assets that will be recorded in the balance sheet. Only the assets that are for the business will be recorded. This is what this concept is saying. 2, going concern concept. The financial statements are prepared on the understanding that the business is a going or continuing one and not on the verge of cessation. It assumes that it will continue to operate in the future and no major part will be disposed of. This one is also saying, as a business, once it is being established, you, the businessman, picture that business to be great. Picture a big figure of that picture or of that business in your mind. Don't have it at the back of your mind that one day, someday, this business will be stopped. In fact, have a big picture in your mind to be like Bill Gates, to be like Dangote, to be like Isiaku Rabiu, to be like Adetola, all these richest men. Once you have established a business, have this picture at the back of your mind that this business will continue to exist from ages to ages. So the accounting statements should be prepared to reflect this, that this business is a going concern business. No part of it one day or someday will be sold out, or no part of it one day will be what? Sell to somebody. So that is it. Number 3, money measurement concept. The information in the statement as prepared must reflect only those facts which are capable of being expressed in monetary terms. It defines the type as of information which will be selected and measured by accountants. That is why if we are preparing accounts, we make sure that all figures carry these Naira signs. If you write figures without putting the Naira sign, everybody will be reading those figures as ordinary figures. So in Nigeria, we have our Naira sign. America have their dollars signed. Ghana have their cedis. Sierra Leone also have their leon. Whenever they are preparing statements which are measured in monetary terms, all these signs must be reflected. Number 4, cost concept. The value of these assets are shown at the cost of acquisition. The accountant cannot value assets in terms of future returns it is expected to generate. The value in the books may not necessarily reflect the current value of the assets. This is also saying all assets that were acquired to be used in the business and to generate money must be reflected in the balance sheet with their original prices or with their original cost. If a machine is acquired at the rate of 10,000, every year a balance sheet is to be prepared. That 10,000 must be reflected in the accounts, except depreciation will be charged to ascertain the real net book value of an asset. So all assets, once an accountant is preparing financial statements, assets should be reflected in their original cost or their cost which they were incurred when they were acquired. Number 4, accrual concepts. This concept states that revenue and expenses are recognized and included in the profit and loss account as they are accrued, not as they are paid or received. If a payment is made in advance, it must not be treated as an expense, and the recipient must be regarded as a debtor until it is time to receive cash as it matures. Now this is saying accruals, that is expenses that were incurred during the trading period. Trading period in accounting referred to 1 year, that is from January to December. So all the expenses that were incurred during those months must be reflected. We have accrued, there are expenses that you have paid, but you are still owing. This is saying that the amount owing must be added with the amount paid. And there are expenses already you have paid in advance. And these are expenses paid for, but yet toward enjoying them. So these expenses also must be reflected in the accounts. That is what they said. This concept says that revenue and expenses are recognized or recorded or either included in the profit and loss account. And that is where, when we are preparing the profit and loss account, adjustments are made. We add outstanding expenses to the ones that already have paid, and then expenses that were paid in advance, we subtract them to give the actual amount that is paid during the trading period. Number 6, matching concept. This concept states that all expenses are matched against the revenue generated at that period to determine the net income. Now, this is saying an accountant, when preparing accounting statements, all expenses will be added together, are expected to be recorded, and all incomes also should be what? Recorded. And this is found in the profit and loss account. Expenses will be recorded on the debit side, and income will be recorded in the credit side. They said they should be matched against. That is, once that is done, the difference will be struck out. And then the difference will give either net profit or net loss. So the gross profit is not yet the profit that you dip your hand and start spending it. No. Because there are so many expenses therein whereby you have to subtract them. And when you subtract them, the net profit is what you can at least dip your hand and spend it. So this is saying that they should be reflected in the account or in the accounting statement. Then we have dual aspect concept. Dual aspect concept. The concept states that all transactions must have two aspects. One, debit, and the other, credit. In accounting, there must be a giver and a receiver of value. There must be a giver and a receiver of what? Value. The practice of accounting rested on this principle. That is the principle of double entry. This dual aspect, dual means two. So in accounting, any account that is prepared not in line with the principle of double entry, it is never an account at all, but rather it is a statement of affairs. So any record that you are going to keep or an accountant is going to keep, he must make sure that record passes or is kept in line or in compliance with the principle of double entry, which says for every debit entry there must be a corresponding credit entry, and if there is a credit entry there must be a debit corresponding entry. So this aspect is one of the cardinal principles in accounting, which an accountant must have to bear in mind when he is preparing financial statements. Number 8, realization concept. The concept states that revenue is recognized as soon as goods are passed to the customer in exchange for valuable consideration. Valuable consideration here is referring to money. This concept is saying you cannot record what you have not gotten, what you have not realized, what you have not sold. If somebody just make some inquiries, he has not purchased the goods, but you have started counting the profit of what you are going to get. As an accountant, when you are preparing financial statements, what you are expected to do is record what has been sold, and the customer already has taken the responsibility of those goods. That is, he has paid the money and taken the goods to his location. Then the money realized is what is to be recorded. Don't record what you are expecting to get. That is what this realization is all about. What you sold, cash in hand, is what you are going to use to prepare financial statements. Number 9, Materiality Convention. Materiality Convention. Materiality Convention. In this convention, it says, in the preparation of accounts, amount of material value only must be recorded. The concept states that accountants should not report certain economic event when the result of doing so is insignificant, as it would not affect the financial statement. For example, depreciation of a stapler. Now, that depreciation is insignificant, is minor. That's what it's saying. This is simply saying minor items should not be put into consideration. What I'm putting here, what you can see here, or there are minor, a stapler. A stapler is minor. When we talk of First Bank, First Bank will never count a stapler as an asset. Nigerian Coca-Cola bottling company will never count a stapler as an asset, because it is what? Insignificant. So this concept is saying these insignificant items should not be considered, because they will distort the results of the financial statements. Number 10, Conservatism Convention. Conservatism Convention. The accountant's view of his responsibility to the organization from whom he provides information is often expressed by this practice. By this principle. The accountants, in view of his responsibility to the organization for whom he provides information, is often expressed by this principle. It states that A, income should not be anticipated, and all possible losses must be provided for. As a businessman, don't always think of profit, but always think of what? Losses, so that you guard against losses. Already you have acquired goods. What you are going to guard against is what? Losses. It's just like we human beings. Yes, we have married, given birth to a young baby. The problem of that young baby is not the food that he is going to eat, but the sicknesses that may catch that girl or that child and kill it. You guard against all those things that will harm that child, leading to its death. So the same thing with the business. So here, this is saying that don't always, the accountant should not prepare his financial statements reflecting what the company will get, but always guard against possible losses which the company may incur in the future. Because losses eventually, if not prevented, will cripple or will lead the business to liquidation. If I say liquidation, I'm referring to the business will close up or wind up. So 2, a B, given choice between two methods of valuing an asset, the accountant should choose the lower value. For instance, stock should be valued lower than that of the current market value, as what I've just said. If you are valuing assets, don't always value. You have the asset, value your assets lower than what? That of the market value. Maybe you are a manufacturer, you have produced goods. Don't value your product more than that of the market. If you value your product more than that of the market, if you carry your product to the market, you will be selling at a loss, because you are bound to lower them to be at par with your competitors in the market. 11, Consistency Convention. This convention says that similar transactions within the same period, and between one period and another must be dealt with in a consistent manner. Methods must not be changed at will, as this will lead to distortion of profits. So here, if you are using reducing balance method, use that reducing balance method from January to December. If you are using a straight line method, use that straight line method from January to December. Don't change. But if there is need for a change, it must be necessary. But this is saying once one method is adopted, that method should be used within January to another. Within the trading period, don't use two methods. Use one method, unless there is a need for that change. Students, we have come to the end of this lesson. But in summary, let's have a recap over what we have learned. Accounting concepts and conventions are principles or rules and conventions which must be put into consideration when preparing financial statements. They are so basic that if any of them is altered, the entire nature of financial accounting will change. The concepts and conventions discussed include business entity concept, going concern concept, actual concern concept, matching concept, realization concept, etc. So these are, in summary, what we have just learned. Assignment. Question 1. What are accounting concepts and conventions? Question 2. Differentiate between concepts and conventions. Question 3. Write short note on the following. A. Business entity concept. B. Going concern concept. C. Materiality convention. I repeat again. Question 1. What are accounting concepts and conventions? 2. Differentiate between concepts and conventions. 3. Write short notes on the following. A. Business entity concept. B. Going concern concept. C. Materiality convention. Reference. 1. Essential Financial Accounting for Senior Secondary Schools by O.A. Longe and R.A. Kazim. 2. Questions and answers for WACS, SSCE, NECO, and GCE by R.A. Kazim. My name is Mr. Jameson Yaro. As usual, in case you have gray areas that need explanation, you can contact me through this number 090-4695-7453 090-4695-7453. Till we meet in our next lesson. Goodbye.